Today, let's look at how banks and insurers manage their balance sheet. First part, the key concepts. Banks and insurance companies are institutional investors. They take on liabilities by accepting deposits and insurance premiums from their customers. They then invest assets to generate returns in order to pay for these liabilities. Banks and insurers want to manage their assets and liabilities in such a way that their investment portfolios can withstand sudden changes in market conditions. This is the reason for balance sheet management. A company's equity is the difference between assets and liabilities. One way to improve the resilience of the company's finance is to reduce the duration of its equity, which means to reduce the equity's sensitivity to changes in interest rates. Another way is to reduce the volatility of the equity capital of the company. When a company's equity return is less volatile, the company can be expected to have more stable performance, which is highly important for institutions, such as a bank. Second part, the duration of an institution's equity capital. By definition, modified duration, here symbolized by capital letter D, is the percentage change in value of an asset or a liability as the interest rate changes by 1%. By rearranging the basic equation of changes in equity equal to difference between changes in assets and changes in liabilities, we get to an equation where delta Y is the change in asset yield and delta I is the change in liability yield. More importantly, the change in equity over change in interest rate is actually the modified duration of equity. Same thing for asset and liability duration. So, once rearranged, the equation becomes more useful because it allows the calculation of an institution's modified duration of equity capital. Since regulators would like to have stable banks, they prefer banks to have lower equity modified duration. This means that in periods of extreme interest rate changes, banks' equity stays relatively stable. One way to achieve this is to minimize the difference in modified duration between banks' assets and liabilities. The other way is to make assets yield move more closely with liabilities yield, so that the delta I over delta Y value gets closer to 1. Part 3. The volatility of an institution's equity capital. The volatility of an institution's equity capital is the standard deviation of the equity's change in value in percentage. Volatility reaches its lowest value when the correlation between assets and liabilities is perfect and is thus at value 1. Financially speaking, this makes sense because if assets and liabilities gain or lose value at the same time, the equity of the institution will stay relatively stable. Mathematically speaking, this also makes sense because the correlation moves between -1 and +1. This part of the equation reaches its maximum when correlation is at +1. Given the negative sign in front of this part of the equation, the value of the whole equation reaches its lowest value when correlation is at +1. This again confirms the concept of equity volatility minimization through perfect correlation of assets and liabilities. Of course, this perfect correlation is difficult to maintain and breaks down even more easily during turbulent economic conditions. This is why, in addition to correlation, banks and insurance companies also need to maintain adequate leverage ratio, because when a company is highly leveraged in an unstable market, the equity capital of the company can see its volatility increase significantly, and the company may suffer from significant losses. Thank you for watching today's video. Happy studies and see you next time.